Hi everyone, this is Osama Bakhteyar from Phillip Research, and welcome to this week's market commentary. This presentation is more of a thematic view on consumer spending, which is a major component of US GDP. Since the 1950s, consumer spending has increasingly gained share as the largest sector of the economy. Currently, consumer spending is more than 70% of US GDP. The focal point of the US economic recovery has been the revival of consumption spending. In theory, consumption spending varies with disposable income. However, dependency on disposable income has much been reduced since the spread of credit cards and other liens of credit. This has led to more volatility of spending as consumers gear up and delever during the economic cycle. The personal consumption expenditure (PCE), which consists of actual and imputed expenditures of households and includes data pertaining to durable and non-durable goods and services on nominal terms, has been fairly muted over the last few years. However, low energy prices and relatively stronger fundamentals should help gain some traction in coming months. Real personal disposable income is the inflation-adjusted amount of money households have available for spending or saving after taxes. Its growth has rebounded since early 2014 in line with the increase in real income. Stronger growth in wages and salaries is essential to the macro outlook because it will help households spend more broadly across the income spectrum, and it matters for monetary policy because the FOMC will remain reluctant to raise rates in the absence of a sustainable pickup in wage growth. Recent developments in core inflation, which is a better measure of long-term inflation as it excludes volatile food and energy prices, may be a leading indicator of firming wage trends. The central idea is that higher prices will motivate workers to push higher compensation. While a stronger income is needed to lift the spending of individuals, a stronger, more fully employed labor force is the key to consumption in the aggregate. While the number of Americans employed has returned to pre-recession levels, focusing on that metric alone masks the depressing effects of America's underemployment and declining labor force participation. The active portion of the labor force is now at the lowest level since the late 1990s. The re-entrance to market, which at this point stands at 1.66%, would put further pressure on the employment. Effect of this, in simple words, would be that any further significant drop in the unemployment figures remains highly unlikely. However, good news is that the number of re-entrants and marginally or partially employed are decreasing since post-recession, moving close to their historical averages. This would put an upward pressure on wage growth. Though underemployed labor has been declining and wage growth improving, both remain far from normal. Well, it does not always ring true, but a happy consumer tends to spend more. Independent to income or cost of credit, consumer confidence depends more on the general economic outlook and is an important factor affecting consumption. The Consumer Confidence Index correlates well with year-on-year growth in consumer spending. After dropping sharply during the financial crisis to a new historical low, it has taken more than 5 years for the index to reach levels considered normal in recovery. Described another way, it has taken more than 5 years for U.S. households to feel like they are in recovery. Consumer credit, which includes revolving, primarily credit cards, and non-revolving, primarily auto and student loans types, and excludes loans secured by real estate, has increased dramatically since the 1980s. Since the financial crisis, however, there has been an unprecedented shift in consumer use of revolving credit. Prior to the financial crisis, there was not 1 year that revolving credit balances declined. But in 2009, those balances dropped to 8.8%, and in 2010 by another 8.3%. Since then, growth in revolving credit has increased and at an accelerating pace, but at 2.1% year-on-year growth remains far from historical average. The result is growing amount of available unused credit. We should expect revolving credit to pick up some pace, a good sign that household credit conditions are improving. As financial conditions improve, middle and lower income households should feel more comfortable adding to debt levels to fund spending. We expect growth in revolving credit to accelerate over the next 6 to 12 months. To wrap things up, as labor market, income growth, and availability of credit increases, certain categories of spending are likely to benefit. Consumer discretionary, example, recreational goods and airlines, and consumer durable, example, furniture, autos, segments should be the main beneficiary from the improvement in job market, especially rise in income. Lower end consumer discretionary, example, food, healthcare, clothing, footwear, and household services should benefit from easier credit to consumers. With this, we end our market commentary. Hope you found it useful. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos. Thanks for watching it, and until next time, salam.